Today, we're going to redefine the trend or the direction that trend or the price is moving toward to. So that is the number one question. Everybody want to know what direction to trade today. And this is the most important question because the trend is, people used to say, it is our friend. And the most common way to define the trend, which I no longer be aligned with. So it's basically when the price is making new lows and new highs over here and new lows over here, then the trend is going this way. That's very common. I may say view that I no longer attached to. So, or the price is simply going this way, and we know that building a new lows lower than previous lows and lower highs than previous highs define that where are we going to. Now let's redefine the trend and build a very new perspective that you no longer will be attached to the old and antique view, because structure is important, but the structure doesn't show us where we should be trading, because the structure is the main goal of the structure is for the price maker to show the direction that every trader will align it to in trading toward to, just to get traders into the trap. So there's a new way to look at the direction, how we define the directions where what we need to trade toward to. Okay, so now basically we're starting with this accumulation range. It is accumulating the contracts because the price maker have always deficit. It doesn't have enough orders in opposite direction, because when the price maker want to trade, it needs a lot of orders to match with. And how the price maker gonna do it? Just building accumulation range where the bunch of people sitting and align it at the top and at the very bottom of it, and trading maybe between the top and bottom. Very simple. Now, when the price builds a range, then the next step is the price before going higher, it knows that there is an external liquidity sitting right here. This is the external liquidity. And who is external liquidity? Who composed this liquidity below this line? It is the people who would like to trade lower because they define it by whatever the system they trade with, they define it that the price will go lower. So they define it to short from the bottom of this range. And then there's other people who would like to long, they buying, and they put their stops right below this line. So there's a one-sided liquidity, one-sided. But the better way is, by the way, I don't like the terminology by the Michael Huddleston. I think that he belongs to the psyche house by composing all of this freaking terminology that doesn't belong to our normal people. Okay, it is one directional liquidity. It is because when the stops are getting broken, they will go into the orders in opposite direction. There will be a sales. There is a one directional liquidity that sits below this black line. It is external liquidity. And after price build accumulation or accumulate some orders in this range, it loves to do manipulation to grab that external liquidity and turn all of these guys into the opposite, because he want to match the opposite orders in opposite direction. So the price maker, before going higher, going lower with this red bar, it induced traders to trade into sales. And immediately, because of the internal construction of the range and the manipulation, there is a lot of energy that builds up, and after manipulation, the price will shoot up. The price actually have a hard time to stop. It doesn't want to go fly that fast because everybody is seeing what the price maker is intended to do. It's very obvious. So, but the internal mechanism of this block, the order block with manipulation, is built the way that there is a lot of energy that propel the price into the impulse, okay? Into the impulse. So first, accumulation, second, manipulation. Now then we breaking the structure, number 3, we're breaking the structure with the strong impulse coming out of this range. And this is the direction where we supposed to consider our trade too. Usually price will, after the impulse, will come back. Why the price will come back into the impulse? Because impulse, to say it very simple way, it is internal imbalance. And the internal imbalance where the inside of that candle, they're only buying a lot of contracts, and the sales are very small. These guys have very large orders because they don't have a resistance. Resistance was killed in this range. And this is very teeny, like sometimes it's very 0 or maybe 1 contract or maybe 2, 3, 4. Most of the imbalances inside of that candle build that way. So we have to remember that the impulse, it's what we visually construct in our eyes. We're seeing the impulse, but inside of that impulse there is sitting one directional liquidity. This is what imbalance is. So maybe it's a new definition for somebody who never thought that imbalances inside of the impulse candles. Actually, it is a one-way liquidity. So maybe for some of you, it will be a revelation that the impulse, it is, with imbalance, it is internal liquidity. And the price moves from liquidity to liquidity, not from the top to another top, not from the bottom or a low to another higher low. That's not how the price moves. What we're seeing with the structure, it is the external way to define where the price is moving. But this is what happens inside of that moves. This is the internal mechanism. This is the fuel that makes it possible. And now you'll be able to identify when price is reversing. When price doesn't have reaction over here, the price is reversing. When price doesn't have reaction on next stop, the price is reversing. So the lack of reaction on the liquidity means or equal future reversal. That's how we know. Because that's the new way to define the momentum or the trend. The price is moving from external liquidity into building, actually, first building this internal liquidity, but then it will pull back. See the number 5, pull back into the imbalance. Maybe nobody explained it to you why the price is coming back into the imbalance. Because imbalance, it is internal liquidity, one-way orders sitting inside of this candle. And the price is coming back to meet those one-way orders. And then after price found a reaction from internal or imbalanced liquidity, it will go again and then repeat the cycle. It will go and break the structure. It will go higher than the previous high. And with the same mechanisms like we're seeing over here, the price will propel stronger because it doesn't want to propel this strong. It want to hide it. But because it's the way it builds tension, the price have a hard time to stop. So it just like break the structure. And now what direction we're going to trade? The price shows us what direction we're going to trade. If price is price reaction after manipulation is building this impulse. That is the direction that we're going to trend. And we may expect the higher time frame, the higher chances that the right after the price made this cycle, it's like a microcycle, then the price will repeat it again, and we're going to go the same direction. If price fail, it's like if price is, let's say, pulling back, but fail to find some internal liquidity or fail to have a reaction by whatever reason is, then the price is going to go lower and find again in another internal liquidity imbalance place the support. If it couldn't find the support there, there's no reaction on this liquidity again, then the price is going the other direction and will build a lower low. So simply to put, the price going from internal to external liquidity. Imbalance is one directional internal liquidity. And the price is expected to go and continue this cycle going the same way where you see the impulse candles. And this is what the price is doing. Price is always seeking liquidity. And if there's a reaction on that liquidity, then the price reacted and continue its move as an impulse. If there's no reaction on liquidity, that means the price is seeking another pool of liquidity on its way. And most likely, it is going to reverse. This is how you can think about difference between the pullback and reversal. Reversal demonstrate as exhaustion. There's many other ways to see the exhaustion, especially with the volume footprint indicators. It is an excellent way to see if the price is exhausted or not. And let me give you another interesting hint. Okay, if this very structure is not only sitting on your 30 seconds chart, which I like to trade 30 seconds charts, but inside of the other time frames. So the price, as we know, is fractal. This is the 30 seconds time frame. But if I know that I'm sitting inside of the 15 minutes time frame, and this is the manipulation on 15 minutes, which is aligned with me now considering in 30 seconds going up, but I'm sitting in a 15 minutes time frame, then the momentum that is built in a 15 minutes time frame will help me to reach new goals. Absolutely. Now I can shoot higher and take more ticks into my profit. But what if I'm sitting inside of the 1 day time frame, which you can look at and you can see if we sitting in the same kind of the structure that price now intended to go and make a new higher break on a 1 day time frame or even 1 hour time frame. That means we're using momentum of the 1 hour or 1 day time frame. If we're seeing that we're actually sitting right there, right here, right, this manipulation on a 1 day time frame, that's exactly the same point where we're sitting on a 15 minute and we're sitting on a 30 seconds time frame. That means kudos to us, because we're going to make a new break of structure. Just entering somewhere like here on this manipulation, we're going to go and take many times more ticks and more profit and be confident that we don't have to even go and strike 30 seconds, enter into the 10 ticks, another 10 ticks, another 10 ticks, and going higher and higher and higher and higher. If you see yourself, don't forget about that, in a higher time frame cycle, that means you can utilize that bigger momentum when you're entering on a 30 seconds time frame. And this is the key You have a very small, teeny stop loss and make a large risk and reward ratio if you wanted to. So if you train yourself on a 1-day time frame, going to 1 hour time frame, 50 minutes time frame, seeing those cycles and the same patterns, then you're able to trade the very small time frame, like 30 seconds, and sit and wait until the price actually will fulfill you into a very large profit you never took before.